Okay, so today we're going to be going over the Homestead Senior Disabled Veterans benefits within the Office of Tax and Revenue. All right, so this is what we'll be covering today. We'll be covering Homestead Senior Disabled Veterans, the Tax Deferral Program, Senior Rescissions, and the Assessment Cap Credit. Okay, so we're going to go over the requirements for these programs, how they're reviewed, and what to do if you disagree with a decision. Okay, so the first thing to kind of understand and go over is just to know that everything starts with Homestead. So everything is kind of built off of having that Homestead benefit. That is the basis for everything benefit-wise within the real property division. So to apply for Homestead, Disabled, or the Senior Citizen Homestead, Disabled, or Senior programs, you must first be domiciled in the District of Columbia. And this means that the property that you are applying for the benefit on must be your principal place of residence. So in order to verify that this is your principal place of residence, we look for certain indicators. And those indicators that we use are your driver's license or ID card, your voter registration, if you're actively voting in the district, and your income tax returns. So we pull your income tax returns to see that you're filing from the address that you are asking for the benefit to be placed on. Okay. So also important to note is that you cannot own property elsewhere with real property benefits. So the homestead benefit is called different names in different jurisdictions. So it's not always called homestead. The important thing to know is that you cannot receive the homestead benefit if you are receiving another likewise benefit in another state. They're called different things, but they are all real property benefits that are specific to domicile. Okay, and the homestead benefit provides you an $84,000, this should be deduction, in your taxable assessed value, which is a savings of exactly $714, which is split between the first and the second half bill. Along with the homestead benefit, you will receive a cap credit. So this cap credit prevents your taxable assessed value from going up more than 10% a year. So what does that mean? That means that if your home is valued at $100,000 one year, and then so say the next year your assessment goes up to $150,000, we will only tax you on $110,000. We will only allow for a 10% increase in taxable assessed value, even though the home is worth $150,000 when you have that homestead benefit. Okay. Okay, so this is the homestead deduction program. It just kind of shows how you apply. You go on mytax.dc.gov, and I also have like a help guide if any of you need it to apply for the homestead senior benefits via our web portal that I can send to you. But this just kind of gives a light overview of it. You go to real property and view more options and submit a homestead deduction application. And it kind of walks you through, and later on in the slides, I'll show that. Okay. And then this shows what the bill would look like with the benefit. And it shows how it lists right here. If you have the homestead deduction under additional information, it'll tell you that you have it and how much your bill was reduced by. Okay, so next is the senior tax benefit. So like I said initially, everything is built off of the homestead. So you must first be eligible for the homestead benefit in order to qualify for the senior benefit. So in addition to the specifics of the homestead benefit, for senior, you must be 65 years of age or older, and you have to own at least 50% of the property. And we are going to pull the deed on the property to verify ownership. So what that means is ownership is split equally. So if there are two people on the deed, that's 50% ownership for each person. If there are three, then that's usually 33 and a third, unless it's specified that it's vested otherwise. So we just pull the deed to determine if you have 50% ownership on that deed. And to qualify for the senior tax relief in tax year 2023, the total household FAGI income for 2021 must be less than 149.4. The reason why we go off of 2021 income taxes is because within the real property division, we run on fiscal years. And the fiscal year is from October 1 to September 30th. So the fiscal year for tax year 2023 started in October 1, 2022, and it'll run until September 30th, 2023. So taxes for 2022 may have not been filed yet, so we will go off of 2021. Do I have a question, Jacqueline? You have your hand raised. If you want to unmute for the questions, it's fine.
Yes, good afternoon. If I am home ownership and you say you have to have 50%, we had worked on the deed for my mother's house, and now my brother and my name is on the deed. So you said it has to be 50%. And now that she's passed, how would ownership, well, how would that be if you said it was 33% for three people's name who's on the deed?
Okay, so your mother is now passed. So you would need to get the deed redone since she is not on the deed anymore. It's you and who is left on the deed? You and your brother?
Yes.
Okay, so that's an automatic kind of rolled into 50% because
Okay.
there's only two of you now.
Yes.
But I would recommend having the deed revested, just so that it specifies that you two are the only two on it.
Okay, even the will states and the deed states that if she passed, that we were survivors.
Mm-hmm. Mm-hmm.
Okay, so we have to revest it. Okay.
And thank you.
Mm-hmm.
Eddie, is there anything else you want to add to that, or did I miss something?
No, I think that addresses the question. I mean, but in some cases, they may submit an application, and if whoever is deceased, if they show proof that they are deceased, they will consider that as well with the application.
All right, I will consult my lawyer as well.
Good. Yes. All right. Do we have
Ann Dennis also has a question?
You basically just answered it.
Oh, that's perfect.
Yeah, thank you. I do want to ask if I die and I give my son.
I can't hear you anymore, Ann.
I'm sorry, she just cut me off, but she cut me back on. If I die and my son would be my heir and he's in the will, but his name is not on the deed. If I put him on the deed now, I'm over 65. If I put him on the deed now, will that hamper me from getting the homestead? Because I get it.
As long as you are vested at 50%.
Okay. All right.
And
okay.
You don't need 50% just for homestead. You need it for homestead senior.
Okay, yeah, that's what, okay, I get that homestead senior
Yeah, and you also might,
and disability.
right, and disability is 50%
Mm-hmm.
for that one as well.
Yeah, I get that.
Okay,
Okay, thank you, Miss Hampton.
you're welcome. All right. Okay, so any more, Janelle?
Yes, can you hear me?
Qualified.
Yeah.
Okay. Do you need a lawyer to have a deed revested?
I don't believe you do. I don't work in recorder of deeds, but I don't think you need a lawyer. I think you just need to fill out the forms that they have for you to fill out.
And is that down on 4th Street Southwest?
The recorder of deeds is in our office, is in
Oh.
1101.
Where are you?
1101 4th Street.
Oh, okay, that's 4th Street. That's the area down by Southwest, right?
Yeah. Mm-hmm.
Okay.
Across from that Safeway.
Uh-huh. I know exactly where it is. All right, thank you.
Hi,
Hi.
yeah, I got a question. If the person puts their son on the deed now, does he have legal rights to, say he want to get a loan, he don't tell his mother about it? Legally, he can do that, right? If he decides to get a loan against the house, don't tell his mother anything about it, can he do that legally?
No, because you're on the title. So, and I only know because I worked in banking, anybody on the title has to sign off for a person to get like a home equity, you mean?
Yes, ma'am.
Yeah. So he couldn't just get a home equity loan without the other person that's on the title knowing. I can't hear. Was it Sylvia speaking?
Yes, I have a question. If you have property that has been left after someone passed, and instead of being two people that inherit the property, let's say you have three people or either four people, will you still be able to get the senior discount if only one person is a senior?
That one person that is the senior has to own 50% of that property.
So if it's three other people, they cannot get the senior benefit, in other words, because the
Unless-
other three people are not seniors.
Only if it's vested that the other three people are taking the other 50%. You understand? So if the senior has 50%, they can vest it so that the other three people that it's split, that other 50% is split among them.
Oh, okay then. All right then, thank you.
Okay. You're welcome. And as always, consult a lawyer. They can help, move through these kind of processes to make sure that your deed is set up right.
Okay, thank you.
Mhm. Lois? Does Lois have a question or we good?
Yes, I do. Can you hear me?
I can.
All right. My question is this: I've heard of the transfer on death deed, and I have looked into that somewhat, but on the form there is space for only two persons. Is it possible to name four people on that transfer on death deed?
That you would have to talk to Recorder of Deeds about. I'm not sure how that paperwork is filled out for the transfer on death.
All right. Then I have to go to a personal lawyer. I can't do through the Registrar of Deeds office.
You can, that's where the form is filed, I believe.
Yes.
And maybe they can advise you if you can have more than two people on that line.
Right.
It's
I
just
just,
on our side, on the real property side, we don't know.
all right, I'll try again.
Okay.
Thank you much.
Brenda?
Yes, Ms. Hampton. I'm a senior and I own my own home and I have all of those benefits, the CAP credit, the homestead and the senior credit.
Mhm.
Do I have to renew this each year or does it, automatically take place every year? Do I have to do anything?
No, you don't have to recertify every year.
Okay,
Only,
Okay.
if you get something in the mail from us that we need some information or something like that, then just make sure you respond to it within the time frame, but you don't have to refile for these benefits every year.
great. Okay, thank you very much.
All right. Do you have time for another question, Ms. Hampton?
Yes.
You do? Okay, Yvonne, go ahead, Yvonne. Ms. Irvin?
Okay, thank you so much. In the event of my passing and my son or my daughter inherits my property and I qualify also and I get the homestead deduction, Schedule H and all the benefits, how does is the office notified and suddenly those benefits are withheld if they're not 65 years of age, those who inherit the property? How do they go about notifying the Office of Tax and Revenue?
So they would send in a cancellation to us with your, just letting us know that you passed.
Mm-hmm.
And then we will do a reassessment of benefits based on who's on the property now. They would have to qualify for whatever benefits they qualify for.
Mm-hmm.
Okay.
But immediately they must file for that cancellation immediately.
I think it's within 30 days. Is that right, Eddie?
Oh, I'm sorry. Wait a minute. Yes, that is correct. You should file immediately. And 30 days is definitely within the time frame that is requested on the form. Oh,
Hi, Ms. Hampton and Eddie. This is Paul Smith, the DC Taxpayer Advocate. May I just make a comment on that, please?
certainly.
Sure, great. One thing I would just want to, I guess, point out on that is, in the unfortunate event of someone's passing and whoever inherits the property, if they are not 65 years or older and the property qualified for the senior deduction, if that senior deduction maintained on that home for 6 months, a year, 2 years, or whatever, until that property is audited, if it is found out that the current owners no longer qualify, unfortunately, any of the benefit that was received during that time period in which they did not qualify would have to be paid back. So it's extremely important to make sure that you keep that up to date.
Thank you. That's good to know. Thank you.
You're welcome.
All right. Can I move forward? Good.
Yes, if you have any questions, we can let her finish out the presentation and then we can have that segment where we can do Q&A.
Okay.
Yeah.
Okay, so I think I left off on senior cap. So on as a part of the senior benefit, much like the homestead benefit, there is a cap credit. The cap credit on the senior benefit is 2%. And that started with fiscal year 2023. Previously, it was 5%. So like I said with the homestead, so say your house is worth 100,000 and then the value goes up to 150, we will only tax on 102 if you have the senior benefit. Okay, so that's what how your cap credit falls. Okay, and this is for the disabled tax benefit. And like I said, you must be first eligible for the homestead. And for this benefit, it's similar to the senior in specifics as far as household AGI and the cap credit and ownership, 50% ownership. But with the disabled benefit, you have to have been certified by SSA as permanently and totally disabled. And what we get to prove that is like your award letter, just showing that from the Social Security Administration, showing that you are permanently and totally disabled. Okay. All right, so the Disabled Veterans Homestead Benefit. This is a new benefit that started with tax year 2023. Okay, and the one thing that is different about this benefit is that you don't apply through us. You apply for this benefit with the Mayor's Office of Veterans Affairs, with MOVA. So I can tell you the specifics about the program, but the applications are not accepted through our web portal. They're accepted through the mayor's office. Okay, so this program, much like senior and regular disabled, you have to own 50% of the property. You have to be domiciled. We use the same, FAGI. The property must be the principal residence of the disabled veteran. And the property must be occupied by the disabled veteran and contain more than 5 dwelling units. Okay. This benefit is significant. It allows eligibility for a reduction in assessed value of $445,000. Okay. And the reason why it's onset in the mayor's office of Veterans Affairs is because they certify to us that the taxpayer is 100% disabled veteran. Okay, so that's where it starts. That's where the application starts. And then it's sent over to us and we verify the rest of the specifics like domicile and income. Okay, so like I said, that's a new program with this tax year. And it is started over in MOVA. And if you need more information of how to submit an application, I can send that out. Okay, and for the disabled veterans eligibility, if a properly completed and approved application is filed from October 1st to March 31st, you will receive the deduction for the entire year. If it is filed from April 1st to September 30th, it will be for second half, for half year. Okay, and this benefit does not have a cap credit. It doesn't have a tax cap credit like senior, homestead, and disabled. Okay, and co-ops are not eligible for this deduction. All right. Okay. So the next program we're going to discuss is tax deferral. And I think the biggest understanding about tax deferral comes with just understanding the program. And this tax deferral program is just that. It's a deferral. So it's not an exemption or an abatement. It defers taxes. Okay. So it allows qualified low-income seniors to defer all real property taxes owed currently, prospectively, and retroactively. Okay, the adjusted gross income must be less than $50,000 for the household. And the tax deferral will cease when the aggregate amount of the property tax plus interest for prior tax years is 25% or more of the assessed property value. Okay, low-income seniors may defer at taxes at either 6% or 0%, depending on qualifications. Okay, the 6% tax rate starts when you're 65 years of age or older. Once you hit 75 and you have resided in the property and you have been domiciled in DC for at least 25 years, then you qualify for the 0% interest rate. And like I said, if this is a program that you're interested in, just let me know and I can send you more information and have one of my representatives kind of cover everything with you. Okay. So senior rescissions. Eddie is going to cover the next couple of slides.
Okay. Good afternoon again, everyone. So senior rescission. So in short, basically once a year, and sometime in the time frame of January, February, we review those senior benefits as well as senior properties with senior benefit and disabled benefit to make sure that the household income is not over the threshold. So as you may know, that once a year, the adjusted gross income, the table that is used, it may adjust at the end of the year. Not every year it adjusts, but sometimes it does increase or sometimes it may not change. But if it does change, we always look at the current adjusted gross income of the homeowners who are receiving these benefits. But we do encourage all homeowners that once you file your tax returns for that current year, at the end of the year, this is your opportunity to be proactive. And if you find that your adjusted gross income is over the threshold amount, you may want to cancel the benefits so that you won't end up with a larger tax bill that you're totally unaware of. Okay. Next. And so here's a question, how do we, review these programs? So periodically we get tax tips from internal source as well as from internal source. Whenever properties are sold, we always do a review of the benefits to make sure that the property owner was eligible to receive the benefits. And as I just stated, there's senior rescission once a year. We make sure that the household income is not over the threshold amount. And then we have sample populations that we look at certain properties that within our circle to make sure that the property's benefits are eligible. And then the MOVA, that's the Veterans Program, they are responsible for the recertification of that program with the Mayor's Office of Veterans Affairs. Next. So let's just say in the event that your benefit were removed from your property, so you do have a right to an appeal. So what you can do, you can submit a appeal online, or you may submit a paper appeal. And then if that decision that's decided in your first level appeal, if you're not satisfied with that, then you may go to a second level appeal, which is a commission. They're separate from the Office of Tax and Revenue. And then if you're not totally satisfied with the commission decision, your third level is the DC Superior Court. So are there any questions on those 3 slides before we move on? Okay. All right, Angela.
Okay, thank you, Eddie. Appreciate it. So just briefly, I'm going to go over what our web portal looks like, just so you all can kind of be familiar with it. Like I said, if you do want to certify for any of these programs or submit for any of these programs, I can send you a separate slide that kind of walks you through the process even more in detail, okay? So this is what our landing page looks like. This is mytax.dc.gov. This is where everything starts. To submit for any benefit, you do not need a log on. So you don't have to put in a username and password here to submit for any benefit. You just go straight to the real property section, okay? And then you would click view more options. And then you would click right here where it says submit a homestead deduction application. And this is for homestead, senior, or disabled. You go through, you can put either your square and lot or your address. Either one is fine. It'll bring up the property. And then you click search. Just like this, it'll bring up the property. And then it'll give the specifics that I gave earlier in terms of the homestead deduction, okay? And how you qualify, how you don't qualify. Okay, and then it'll kind of ask you which program you want to submit for. If you click the veterans one, it'll redirect you to the MOVA page. But you can do homestead only, homestead and senior, or homestead and disabled. Okay, and it covers here again the specifics that I went over earlier. Okay, and then it asks you certain questions just to help us move your application along. Like I said, we do pull your records and specifics from the household and from the property owner. And it asks you, when you moved into the property, how long are you domiciled? Is this your principal residence? Is the property in a revocable or special needs trust? Are you at least 50% property owner? Excuse me. And do you have any co-owners? Do you own property in the district, elsewhere in the district, or elsewhere in general? And do you have any tenants? The reason why we ask this question is because if you do have someone that is a tenant in your property, we can exclude their income from the household as long as we have a written lease, okay, between yourself and that tenant. Okay. Then it asks, your information, active duty military, are you a non-US citizen or G4, and what's your federal adjusted gross income? This says from 2019, but it'll be from the previous 2 years. So like we're in 2023, it'll ask for 2021. And did you file district income tax returns? Then it asks if you have any attachments. Usually here, if you have a trust or anything like that, that can be attached in this section. Then it asks you to certify that everything is true and correct, and press submit. And after that, it'll ask you to confirm your email, because we're going to send you a confirmation that you applied. And then this is what the confirmation looks like. It'll give you a confirmation number so that we can refer back to your application, or if you need any updates or anything like that, you can reach out to us. And then this is just some information, like if you need help, you can always call us by phone, or you can send a web message through MyTaxDC, and you can also go to our walk-in center. Okay. And that's it for my presentation. Another thing that I do want to highlight is that if you are not computer savvy, or you don't have access to a computer, we do have paper applications that we can send out to you on request. For these benefits within our web portal, we do have a 30-day turnaround. It will take a little bit longer if we have to send you out an application, because then you have to mail it back, we have to upload it, and then we have to work it. But we do have that available as well. Okay. So that's it for my presentation. Do you all have any other questions?
I don't see any hands raised at this moment, so I think we can go on to our next presentation.
Okay, and I'll drop my information in the chat if any of you want to send me an email or something like that, if you have some follow-up questions, okay?
Okay.
Yes, Teresa, we now have Andrea Holly here. Can you make her a co-host as well?
I sure can. Let me
Thank you,
find
sir.
her on the list. Holly, I see her. Now I'm going to make her a co-host.
And Andrea, let me know if you can pull your presentation up. If not, I can. for you.
Okay, I just did.
Thank you.
Mhm.
Hello, everyone. I hope you can hear me.
Yep. we
Yes.
can.
Okay, great.
Yes.
I was having problems signing on to the Zoom, but I'm here, and I'm going to share my screen. Hopefully this works. Can you all see this?
Yes.
All right. And I will be presenting the Schedule H homeowner and renter property tax credit for 2022. It is presented by the DC Office of Tax and Revenue. And I welcome you all to this presentation. Okay, so what exactly is the Schedule H tax credit in Washington, D.C.? This is a government-funded credit that is given to homeowners and renters in Washington, D.C. that qualify. The term home refers to houses, apartments, rooming houses, condominiums, and cooperatives. This credit may not be claimed if you live in a property owned by a government, a house of worship, or a nonprofit organization. All right, and you may qualify for the Schedule H credit if you were a District of Columbia resident from January 1st through December 31st, 2022. Your residence is not a part of a public housing dwelling. You rented or owned and lived in a home, apartment, rooming house, or condominium in DC all of 2022. You did not rent from a landlord whose property was either exempt from real property taxes or who paid a percentage of rental income to DC instead of paying a real estate tax. You must not be claimed as a dependent on someone else's federal, state, or DC income tax return unless you reach age 65 on or before December 31st, 2022. Your 22 federal AGI, which is adjusted gross income, was $57,600 or less. If you are 70 or older, the AGI cannot exceed $78,600. And those were all reasons that you may qualify for. Additional qualifications: a homeowner and renter property tax credit cannot be claimed on behalf of a taxpayer who died on or before December 31st, 2022. Only one claimant per tax filing unit can claim the property tax credit. For example, a married couple or registered domestic partners residing in the same household are part of the same tax filing unit, whether they are filing jointly, separately on the same tax return, or separately on separate returns. So basically, that's just one credit for one household. An individual who is claimed as a dependent on someone else's individual income tax credit is eligible to file the claim for his or her tax filing unit only if the individual is 65 years of age or older. How do you claim the 2022 Schedule H? For D40 filers, if you are required to file a DC individual income tax return, which is our D40, attach the Schedule H form to your D40 return. Use the federal adjusted gross income amount from line 4 of your D40 and the AGI of your spouse or your registered domestic partner in filing separately on separate returns. You may use 3 years from the due date to claim the credit. If you have already submitted your tax return for a previous year without the Schedule H form, you may file an amended return to include Schedule H. So that means you can go back 3 years to claim this credit. For standalone filers, if you are not required to file a DC individual income tax return because you are below the income tax filing threshold, you can file the Schedule H as a standalone return. Also, we are now offering this electronically. You can file the standalone Schedule H by accessing the mytaxdc.gov portal. If you need assistance with the online system, you can call our e-services team at 202-759-1946. When is the Schedule H due? The Schedule H tax return is due by April the 18th, 2023. And where do you mail the Schedule H? If you are required to file a DC income tax return, attach a Schedule H to your DC income tax return, and you can mail it to the Office of Tax and Revenue, P.O. Box 96145 in Washington, D.C. 20090-6145. And that's for people who just do not want to access it electronically. If you are a standalone filer, not required to file a D40 and you want to mail it in, it goes to a different address. You may mail or deliver that form to our office. It's the 1101 4th Street Southwest, 4th floor, Washington, D.C. 20090. And that's for our standalone filers who do not want to mail it in. And right here on this screen, I'm hoping you can see it. If you cannot, you may be able to zoom in. This is the actual calculation of the Schedule H. And I'll just show you at the very first part of the screen, it shows if you are under age 70 and the federal AGI of your tax filing unit is 0 to 24,999, then you're going to use the calculation based on the 3% of your adjusted gross income. And it just goes down into different categories for your income. And then there's if you are age 70 or older, and your federal AGI is 0 to 78,600, then you use 3% of the adjusted gross income. And this is the formula down there. And you can see there the amount of the tax credit is $1,250 this year. That credit does fluctuate. It has gone up. So it's a great benefit for those taxpayers who qualify. And unfortunately, a lot of taxpayers do not take advantage of the credit. So we're just really trying to get a lot of our DC residents to become aware of it and take advantage of this credit that could help so many. And finally, if you require additional information, you may contact me. I'm Andrea Holly. I work on the 7th floor in the building at 1101 4th Street. There's my email address and my phone number. If you have any questions, you can ask me now if you like, or if you want to just send me an email or give me a call, I'll be happy to help.
Yes, it looks like we have one question. Let me open up the mic.
Ms. Dargan, can you unmute and ask your question?
Yes, my question is regard to the cost of living increase that the president had given to persons who receive Social Security. Is that taxable income, and do you include it in this tax year? Hello, can you hear me?
And that question is pertaining to the Schedule H?
I'm not sure. It's just additional income for persons who receive Social Security.
I do believe that it is not taxable. However, there are some parts of Social Security that is taxable, and I can find out exactly how much of that is. If you would give me an email address or a phone number, I can clarify it and let you know.
Okay.
Hey everyone, this is Paul Smith again, the DC Taxpayer Advocate. So just to answer that question on that, generally speaking, Social Security benefits themselves are not taxable. The only time in which Social Security will actually become taxable is if you have an outside source of income. So if Social Security is your sole source of income, then you don't have to worry about it, even if there is an increase in that Social Security rate. If I'm not mistaken, the increase for Social Security was during the 2023 calendar year, so which would be the 2023 tax year. And so again, right now we're dealing with tax year 2022. So what you would need to do is look back at tax year 2022. If you had no additional income outside of your Social Security, then none of your Social Security is taxable.
Okay, thank you.
You're welcome.
Thank you, Paul. That makes perfect sense.
You're welcome.
Are there any other questions?
Yes, Sylvie Spinner.
Yes, I would like to know if Ms. Holly can put her information for her email in the chat box. And also if the computer tax credit for your property has a special form number.
Is there a form number for the Schedule H? Is that your question?
No, for the tax credit part. Is that all part of Schedule H?
Yes, when you're filling out the Schedule H, it's just a form itself. You'll be able to look it up. It will say 2022. I can send you a copy of that if you'd like.
Okay, that'd be fine.
Okay. And I'll put my contact information in the chat.
Thank you.
You're welcome.
Ms. Queen Jones, go ahead and unmute.
Yes, I did. Supposing that a person doesn't have a house in DC, and if you wanted to, say they haven't been filing the taxes, can they file the taxes in order to get the tax credit just for a person living in DC?
So they're a renter, I'm taking it?
Yes, renter, don't own a house, but tax credit.
Yes, they can apply for that, yes. For the last 3 years, they can go back.
Okay, thank you.
That appears to be questions on this section. Do we have another presenter?
Yes, we do. We have Office of Tax and Revenue's new taxpayer advocate, Paul Smith. Are you able to share your screen, Paul?
I am. Give me 1 second here, sorry. And sorry, everybody, I'm having a little bit of issues here. Let me jump in. Was I granted?
Permission? Paul
Yeah.
Smith?
Yes.
Let's look and see.
So it says only one participant can share at a time. Is somebody
Okay,
sharing?
yeah. So is there
And
someone
then
else
just
sharing
sharing-
currently? There must be someone else sharing currently. Still
Right.
sharing. Let me see if I can drop them. May have been the last person. Let me just check. All right. Try again, Mr. Smith, and see what happens.
No, it still shows that somebody
That
else
person is still showing a sharing.
Yes.
All right, let me figure out who that could be. So I've dropped the last person who shared. Hold on a moment. Let me see if I can manage it from this end. All right, let's try it. Who can share? All right, let's try this. Try this time again.
Okay.
Any luck?
Not yet, unfortunately.
Not yet.
No.
That is strange.
It still says that only one participant can share.
I'll have to drop the co-host of others then.
Maybe that would help.
Yeah, I might have to go there and see. Let me just remove co-host from the others for
I
now.
know Zoom
Except for
sometimes
you
have
and
a
Mr.
lag, if
Bruce.
you will.
Yeah, I'll have to remove from others for now and remove co-host. That way they can't share anymore. Now I only have 2 of you who can share. Hopefully yours, Mr. Bruce and Mr. Smith. Try again.
Think we might have some success here.
All right.
All right. Can you all see?
Yes, we can.
Perfect. Great. So good afternoon, everybody. My name is Paul Smith. As mentioned before, I'm the new DC taxpayer advocate. And thank you everyone for joining us today. I guess I think I'm picking up on the tail end of this presentation. So it sounds like a lot of my colleagues have already presented a lot of the tax benefits that are available for seniors. So a lot of what I have in mind is sort of encompassing everything together. So I'm going to skip through a lot of what we have because everyone did a great job today talking about, the real property. I'm sorry, I skipped too much before I say this actually. So a lot of my colleagues already talked about a lot of the real property tax benefits for seniors and some of the income tax based benefits for seniors. So I'm going to pick up on 2, if you will, that have not been addressed that specifically deal with, one specifically deals with seniors, but one may deal with seniors. And you'll see what I mean by that in a second. So again, I'm going to just click through several slides here, and I'm going to pass through all of the real property type of benefits that seniors have. And instead, I'm going to jump directly into, if you will, the income section. So these are some of the benefits that seniors can afford by the income tax on side, as opposed to the real property side. So one of the things I want to highlight is that just by a function of being born before January 2nd, 1958, one of the things I want to make sure that you're all aware of is that your standard deduction actually automatically increases. Now, what do we mean by that? So as we may know, we have a standard deduction and an itemized deduction. Everyone is afforded the standard deduction, no matter who you are, so on and so forth, you get the standard deduction. Itemized deduction is for those folks who own a property and they actually have a mortgage and they can try to write off their mortgage interest. They have property taxes and they try to write off their property taxes, or they may have charitable deductions, or they may have out-of-pocket medical expenses. If those expenses that I just mentioned don't exceed the standard deduction, then you're going to want to take the standard deduction. If those expenses exceed the standard deduction, then you're going to want to take the itemized deduction. So as we see here, generally speaking, for a single person, the standard deduction is $12,950. Now, if you were born before January 2nd, 1958, your standard deduction automatically jumps up to $14,700. And that's just as a function of being, again, born before January 2nd, 1958. So that's a huge impact on your taxes, because your deduction is actually what allows you to calculate what your taxable income is. So you have your gross income, you subtract out your adjustments, which gives your adjusted gross income. And from your adjusted gross income, you subtract out your deductions, and it's from your deductions that you then determine your taxable income. So if this deduction is greater, then your taxable income goes down. So this is why this is important. I want to make sure I highlight that and highlight this is that, again, if you were born before January 2nd, 1958, you're making sure that you are getting this increased standard deduction if you're taking the standard deduction. Now, Andrea, who is one of my phenomenal taxpayer specialists in the Office of the Tax, the Office of Tax Payer Advocate, she's already talked about the Schedule H, or the homeowner and renter property tax credit. So I'm not going to get into that. One area that I do want to cover, and this is the earned income tax credit. And this credit is actually a really big credit for folks. And generally speaking, this credit is normally for people who have children. Now, some of you may say, wait a second, we're seniors, we don't have kids. But this credit applies if you have a grandchild in your home that's living in your home. If you have a niece, a nephew, or whoever that's actually living in your home, then this credit may actually apply to you. This doesn't have to be your actual child. In order to qualify for the earned income tax credit, it could be actually somebody dependent upon one of your children. Again, that's what I was saying, grandchildren, niece, nephew, and so forth. So the earned income tax credit, as we see here, is a credit that helps low to moderate income workers to get a break on a refundable tax credit. Now, first of all, what do we mean by that word refundable tax credit? So you actually, in our system of taxation, we have two different types of credits in the income tax side. One's refundable, one's non-refundable. A refundable credit actually allows you to walk away with any credit that's left over after your tax liability has been paid. So for example, let's say you have a tax liability of $2,000 and you have a $3,000 refundable credit. The credit literally wipes out the tax liability, and then in theory, you have this $1,000 left over. If it's a refundable credit, you actually get that $1,000 in your pocket as cash. If it's a non-refundable, then it's just lost. So the EITC, as I said, is an actual refundable credit. So you actually get any portion of that credit that's left over after your tax liability has been satisfied. And we can see here how much are the credits, depending upon whether you have children or not children. And again, when I say children, I'm using that word loosely. This applies again, as I said, grandchildren, nieces, nephews, and so forth. So if you have no qualifying child, you do get a $560 credit depending upon your income level. If you have one qualifying child, it's $37.33. Two qualifying children, $61.64. And three or more children, then the credit can be up to $69.35. So as you can see, this is only on the federal side that I'm talking about right now. So this is a very large credit that you can get on the federal side. And also I want to bring this up just to make sure that if you do have, your own children and grandchildren and so forth who have kids, you also want to make sure that they're getting this credit too. So not only could this benefit you, but this could also benefit, potential family members. So let's take a look at how do we qualify for this credit. So the first thing is that we must have actual earned income. And that can be from self-employment, W-2 if you have a job, tips, employer disability payments, and so forth. Unfortunately, if you don't have anything over on this side and your only source of income is over here, unfortunately, you don't qualify. So, as we talked about a little bit before, if your only source of income is Social Security, unfortunately, you don't qualify for this credit. And again, if your only source is from these other sources, unfortunately, you won't qualify for this credit. However, as long as you have something over here and something over here, you're good. All right. So it's just, you got to have something in this column. So we have what are called rules for everyone, and we have rules for children and rules for people without children. So let's take a look first about the rules for everyone. So you must have a valid Social Security number. And again, this is on the federal side. You must have a valid Social Security number for employment. You can't have investment income that is greater than $10,300. The taxpayers, if they are married filing separately, then they must have a child in common, and they must not have lived in the same residence with the spouse for the last 6 months, or they must have actual legal separation. So rules for everyone. Again, here are our income limits. And again, these are just the income limits, and you can look at those later. Now we have the rules for children. So we basically have 3 tests, if you will, for rules with children. So we have the relationship test, we have the age test, and we have the residency test. The relationship test, as we see here, could be the child, a sibling, or a descendant of any one of these folks. So again, this is why I say this may apply to you, because again, you may have a grandchild, a niece, nephew, or whoever, a cousin in your household. As long as they're related somehow to one of these categories, then that person could qualify potentially for the child under earned income tax credit. They must be under the age of 19 or 24 if a full-time student, and any age if the person is disabled. We do have what's called a residency requirement, which means that basically that the child that you're trying to use for this credit must have lived with the taxpayer for at least half the year. Now, one of the things to keep in mind with this, and this is, some of us may think about dependents, and this, for earned income tax credit, the dependent that we use for earned income tax credit is different than the dependent that we would use for a dependency exemption. And then why I say that is because notice here there's no support test. So in other words, for a dependency for an exemption, you actually had to provide some support for that person. For the earned income tax credit, there is no support test. We only use these 3 tests: relationship, age, and residency. So you don't have to actually support that person who's living in your house as long as they meet these other requirements. So let's take a look at an example here. And then again, this is why I bring this up. Here we have grandma. She's making $20,000 a year. Here we have daughter making $10,000 a year, and we have 2 children. And they're all living under the same, within the same house or under the same roof. So how can we actually, if you will, spread these children out amongst the grandmother and the mom for earned income tax credit purposes? And actually, we can spread these out to really whatever produces the biggest refund for the family unit. So in other words, as we see here, mom could take both children, grandma can take both children, mom could take one, grandma could take one. So again, we just look at what produces the biggest refund. based upon and using the earned income tax credit. So this is a powerful credit that allows some flexibility, again, amongst folks within the District of Columbia that can spread this out. Because again, because you don't have that support test, you don't have to worry about who actually gets the children as long as they're all in the same house, under the same roof. Now, this is the federal earned income tax credit. DC actually has its own earned income tax credit as well. So this is on top of the federal credit. So currently, the DC earned income tax credit is 70% of the federal earned income credit. So in other words, if you get $1,000 from the federal government from the earned income tax credit, you get an additional $700 from DC for the DC version of the earned income tax credit. So that's huge. So that equals up to a total of $1,700 of a refundable credit. Now, the thing to keep in mind is DC has changed their rules a little bit about how that credit is actually paid out. And this is only the DC version of the credit, not the federal version of the credit. And what I mean by that is currently 40% of the credit is paid out with your refund. The additional 60% of the earned income credit will be paid out to you in 11 installments, 11 equal installments over an 11-month period. So again, 40% is refunded with the refund itself. The other 60% is paid out over 11 months. Okay. There we go. Okay, so I just wanted to touch on that credit because again, that could be a very valuable credit for either you, family members, and so forth. Any questions on that or? Great. So that is my portion of the presentation.
Yeah, it appears that no one has any questions on that, Mr. Smith. So thank you for your presentation.